Hello everyone and welcome into the channel. My name is Brent. What if I told you that most investors are leaving money on the table without even knowing it? They build a portfolio, but they only use a fraction of its potential. They'll buy a few stocks, maybe a fund, and just hope for the best, totally unaware that a few key tweaks could completely change the results. Today, we're going to go ahead and cover level up your portfolio in 2025 with 5 investing secrets. So, are you guys leaving money on the table? Most investors unknowingly limit their potential. The good news is you don't have to be one of them. There are 5 secrets the pros use to sharpen their portfolios, and by the end of this video, you'll know exactly what they are and how to use them. We're covering everything from the basics to the advanced strategies for asset allocations and diversification that will fundamentally change how you invest in 2025. The third secret is the key to turning market volatility into your biggest advantage. So, before we get started, a quick reminder, I'm not a financial advisor. This video is purely for educational purposes. Every investment has risk, and you should always do your own research and think about your personal situations with personal finance. Now, let's go ahead and get into the first secret. Secret number 1, asset allocation and the blueprint. The first and maybe the most important secret is mastering asset allocation. You've probably heard the term. It's just dividing your portfolio between assets like stocks, bonds, cash, but most people stop right there. They don't get that it's just a friendly suggestion, but it's the absolute foundation of your entire investment journey. Think about just building a house. You wouldn't just toss a few bricks and a big pile of wood and hopefully it stays upright. You need a blueprint. Asset allocation is your portfolio's blueprint. It determines more of your returns than any single stock could ever. Now, tailor allocation to your time and risk. Your allocation is based on your goals, how much time you have, and your stomach for risk. If you are young and investing for retirement in 40 years, your blueprint will look way different than someone who needs money in 5 years for a down payment on a home, a car, or something else, right? The longer you have, the more you can lean into growth assets like stocks for shorter term goals, and you need some stability of bonds and cash. Now, there are some advanced investments. So here we're talking REITs, real estate investment trusts, rentals, commodities to hedge against inflation, and some international investments. Some analysts also see opportunities in international markets like parts of Europe, Japan, which might outperform this year. Now, let's go ahead and build your blueprint. Here's an action step. Don't guess. Write everything down right here. Write down your financial goals and your timeline for each. Then create a target allocation that fits that timeline and your comfort with risk. For beginners, a simple target date fund can do all of this for you with a 90-10 split. And for the advanced investors, it's time to research how adding just a 5 or 10% slice of alternatives and international stocks could make your portfolio even more resilient for specific climates of 2025 and beyond. Let me know down in the comment section below, do you follow any specific ETFs or any international funds or stocks? Let me know down below. Now, jumping over into secret number 2, diversifying beyond the obvious. Avoid overconcentration. This flows right into our second secret, diversifying beyond the obvious. Everyone knows the old saying, don't put your eggs in one basket. In investing, that's diversification. The classic mistake, though, is thinking that owning 20 different tech companies means you're diversified. You're not, you're just all in one sector. Now, explore sector ETFs for growth. True diversification means spreading your money across different asset classes, industries, and even different countries. That way, when one part of your portfolio is down, another part is hopefully stable or even up, which smooths out your returns and slashes your risk. You can use index funds for core for beginner. This is definitely the easiest way to broaden your market across index funds and exchange traded funds. With one purchase, you can get a piece of the entire US stock market with the S&P 500, such as VOO or SPY, or even the whole stock market, right? There's the simplest and most effective way to build a diversified core, which is always a suggestion out there, right? People always suggest VOO and SPY, which tracks the S&P 500, or VTI, which is a total stock market fund. Now, core and satellite portfolio. So how do the pros take it to the next level? They use the core and satellite portfolio strategy. Your core is your foundation, made of those broad, low-cost index funds that give you stability and market average returns. This should be the bedrock of your portfolio, maybe 80 to 90% of your total investment. Now, that other 10 to 20% are going to be your satellites where you can make target plays on specific sectors or different ideas you believe in. For 2025, a satellite could be an investment in a sector that looks really good for growth around the world, from Europe, Asia, and other slices dedicated to specific international markets with strong growth potential. The core satellite approach gives you the best of both worlds, the safety of the broad diversification at your core, right? That 80-90%, with the potential for bigger returns from your target satellite plays. Your action step is to look at your holdings. Are you really diversified, or are you super concentrated in these tech companies, right? For beginners, this goal is to build that core with one or two broad market ETFs. And for the more advanced investor, figure out what percentage of your core and what are your satellites. And then you could start researching the bigger trends for 2025 and make smarter satellite choices. I know in the past we had looked at different satellite ETFs or sector ETFs. I know some people like to call them spider ETFs. These are a great area to start in. Let me know if you guys are interested in any specific satellite ETFs. Are you guys monitoring and investing in any specific AI or just in areas of the world? Let me know down below. Now, jumping into secret number 3, turn time into your superpower. All right, this is the secret I hinted at earlier. This one is one of the simple ones that's often ignored. It's not flashy training strategy, but it's discipline, which is really tough. The secret is to religiously practice dollar cost averaging, DCA, right? Invest a set amount regularly, otherwise known as dollar cost averaging, a fixed amount of money at regular intervals, whether it's weekly, monthly, $25, $200, every month, no matter what the market is doing. It sounds almost too simple, but it's a really powerful strategy. This removes emotion, and it's the ultimate way of investing, which is the single biggest wealth generator for most people. Buy more when prices are low. Example, when the market is flying high, your fixed amount buys fewer shares, but when the market dips, that same amount buys you back more shares. Over time, this can lower your average cost per share, but more importantly, it forces you to buy when everyone else is scared, sending out those notifications on the internet and selling. It automates good behavior and discipline. For a beginner, this is your ticket to starting without fear. You don't need to stress out about timing the market, buying low, buying high at different times. Just stay consistent. This is the best time to start is now. The best time to start is now, and the best way to keep going is just to stay consistent. So, automate your investing. You can do this by setting up auto transfers to your core ETFs. I know on other platforms like M1 Finance, you could target percentages to, say, for VU, like a 90%, 80%, and it would keep it fixed. And then you could invest into those satellite ETFs or, different sectors around international. But go to your brokerage account right now and set up automatic transfers and investing into your core funds for every week, every month, or every payday. Now, treat it like a bill. You have a pay to bill for your future self. It's not negotiable. And invest during highs and lows because it'll have a really big impact on your long-term wealth that almost anything else you'll be able to do. Swing trading and that day trading, it's going to be generating some short-term fluctuation and stuff, but that true long-term wealth is built by just staying consistent, dollar cost averaging. It's probably one of the more important things that you guys can do. Okay, secret number 4, rebalance for stability. Adjust to stay aligned with your risk. You know what that means? As your investment grows, they'll grow at different speeds. Your stocks might have an amazing year and then suddenly make up 75% of your portfolio instead of that 60% you plan for. This is called portfolio drift, and it's kind of sneaky dangerous. Without you even noticing, your balanced portfolio has become much riskier than you're comfortable with. Now, sell high, buy low is a simple act of selling some of your high flyers and buying more into your underperformers to get back at your original target allocation. It feels wrong when you're doing it, right? When you're forcing to sell your winners and buy what's lagging, but it's critical discipline for managing risk. And this is a really good between some of those, your target date funds do a lot of this. They're already kind of split between 80% stocks and 20% bonds. So when stocks are high flying and say they're 90% of your portfolio and bonds are 10%, they might adjust back down, selling off a portion of your stocks and buying into your portion of those bonds to kind of reallocate your portfolio. Now, annual or percent deviation based. It keeps your risk level where you want it and stops you from being overexposed into one asset class before correction. Think of it like getting your car's alignment checked. It keeps you from swerving off the road. So, nice little tip right there. Now, for the more advanced tips and saving on taxes, rebalancing is often a defensive move. It's built-in system for taking profits, plus it can be done in a tax-efficient way. For instance, if you're selling assets in a taxable account, you might be doing some tax loss harvesting, by selling losses to offset those gains. And if you're using it inside of a taxable account, set a schedule, decide if you'll rebalance based on the calendar once a year, or, let your portfolio do it on its own. Depending on your invested into exchange traded funds, they might already do a lot of this all on their own, right? So if you're investing into one ETF or you're investing into multiple ETFs, if it drifts off more than 5% off its target, they could be a good reminder to just kind of take a look at your portfolios and don't overthink it. Just kind of follow along with whatever your plan is. Secret number 5 and the final one, cut costs and boost gains. High fees equals lower returns. It's a secret that separates good investors from great ones. They relentless focus on minimizing what you can control with fees and taxes and what you can't control what the stock market actually does next year. You can absolutely control how much of your hard-earned money you're giving away to the fund managers and the tax man. So let's go ahead and talk about fees. A 1% management fee sounds tiny, right? But over decades of compounding and investing, it can actually eat up a shocking amount of your returns. We're talking hundreds of thousands of dollars through the next 10, 20, 30 years. The rise of a low-cost index funds and ETFs has been a gift to investors. These funds often have expense ratios less than 0.10, 0.10, meaning you can almost have all of your money working for you. I believe the S&P 500 is 0.02 or 0.04, which is tiny little fraction, right? Use low-cost index funds. I kept messing this word up. Use low-cost index funds for beginners. The lesson is pretty clear here. Always choose low-cost index funds or ETFs for your portfolio's core. High-fee mutual funds almost never beat the market in the long run, so why pay extra for underperformance? Max out those tax advantage accounts. For more advanced investors, the game is all about tax optimization. This means maxing out your tax advantage accounts like the HSA, the Health Savings Fund, the 401k, an IRA, or an FSA. Money in these accounts can grow tax deferred or even tax free, giving your compounding a massive boost. And if your employer offers a 401k match, that's 100% return on your investment guaranteed. You should always contribute enough to get the full match before your investment, before you invest anywhere else. So if you guys have any questions about any specific accounts, drop your questions in the comments. I know we've covered 401ks, IRAs, FSAs here in the past. I think that each one of these has a special place for every investor's heart. Every investor has a place in their heart where each of these is important, right? The health savings account, this is great for dental and for just injuries, right? It kind of covers it all. Plus, it's tax deferred or even tax free. It's all about cutting those fees. Now, ready to upgrade your portfolio? You have the 5 secrets to seriously upgrade your portfolio in 2025. If you guys found this video helpful and you're ready to take charge of your financial future, hit that subscribe button below. I release videos like this every week to help you become smarter, more confident investor. And let me know down in the comments section below, which of these 5 secrets are you going to use first, or which one are you more familiar with? Think long-term and stay consistent. By using these 5 strategies, you're creating a portfolio that's designed to be resilient, to seize opportunities, and to grow steadily into the long term. No matter what the market throws at you in 2025 and beyond, just think long-term, stay patient, and let your strategy do the heavy lifting. Thank you all for watching. I will see you guys in the next video, and subscribe. Bye-bye.